every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning. A warm welcome to Money Talk at the start of a new month. It's Monday the 3rd of July. This is Peter Lewis welcoming you to my podcast, which you can find on Apple Podcasts, Google Podcasts and Spotify. Thank you for making it one of the most listened to financial podcasts in Hong Kong. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, US consumer spending moderated in May, while the Federal Reserve's preferred inflation metric showed that price growth slowed. The US Core Personal Consumption Expenditure Price Index rose by 0.3% month-on-month in May as expected. The index, which excludes food and energy, eased from the 0.4% increase in the previous month, and that put the annualised rate at 4.6%, down from 4.7% in April. The People's Bank of China announced on Saturday that Pan Gongsheng has been appointed to the role of Communist Party chief at the central bank, replacing Guo Shuqing and putting him in line to be the next governor. The party chief is the most powerful political position at the bank, and he can hold more influence than the governor. Mr. Pan is expected to also be announced as the next bank governor, replacing Yi Gang, who has served in the role for more than 5 years. China's manufacturing sector contracted in June for the third straight month, and service sector growth was slower than expected, adding impetus to calls for government stimulus to boost the flagging economy. The manufacturing PMI rose to 49 in June from 48.8 in May, matching economists' forecasts. The non-manufacturing PMI, which includes services, agriculture and construction, came in at 53.2, marginally behind expectations from 54.5 a month earlier. That was the 6th consecutive month of expansion in services activity, but the weakest growth since January. Derivative contracts with a notional value of about $7.5 billion traded in Singapore will shift to India as a cross-border trading link between the two Asian countries' bourses becomes fully operational today. Trading in the Singapore Exchange's futures on India's NSE Nifty 50 index, and all outstanding orders will be transferred to the NSE International Exchange in Gift City, the new financial hub in the western Indian state of Gujarat. The contract will be known as Gift Nifty from today. On today's programme, I'm joined by Alex Wong, Director at Alex KY Wong Asset Management, and John Schofield, Managing Director of Tempus Investments. With a view from Singapore is Geoff Howie, Market Strategist at the Singapore Exchange. And there are several ways to get in touch. You can go to my website, peterlewismoneytalk.substack.com. I'm also on Facebook, Peter Lewis Money Talk is the page, and on Twitter, I'm at Money Talk R3, where under new Twitter rules, you can only read 600 tweets a day if you're an unverified account.
Peter Lewis's Money Talk.
In US markets, the Nasdaq Composite recorded its best first half of the year since 1983. The index gained almost 32% for the first 6 months of 2023 as markets closed on Friday, the last day of June. The biggest contributors to the market rally have been just 7 large tech companies: Apple, Amazon, Microsoft, Nvidia, Alphabet, Meta and Tesla. Apple on Friday hit a new record high, valuing the company at more than $3 trillion, while chipmaker Nvidia has gained 189% in price since the start of the year. On Friday, the Nasdaq closed 1.5% higher at 13,788, leaving it with gains of 6.6% for the month of June and 12.8% for the second quarter. The broader S&P 500 index has risen 16% since the start of the year. The S&P 500 closed Friday's session with a gain of 1.2% to 4,450, and it's up 6.5% for the month and 8.3% for the last quarter. The Dow is the relative underperformer with gains of 3.8% in the first half. It closed Friday 285 points or 0.8% firmer at 34,408. The yield on the 10-year government bond is essentially where it started 2023 at 3.84%, but the yield on the 2-year is almost 50 basis points higher at 4.9%. That leaves the yield curve with a record inversion of minus 106 basis points. That's normally regarded as a harbinger of a recession. In the currency markets, the Japanese yen fell to a 7-month low against the dollar on Friday. The Japanese currency is down 10% year to date, trading at 144.32 to the US dollar. And for 2023 so far in Asia, Japan is the region's best performing equity market with gains of 27.2%, taking the Nikkei 225 to 33,189 and hitting the highest level since July 1990 last month. South Korea's Kospi is higher by 14.7% in 2023 so far. In India, the Nifty 50 hit an all-time high in June and is up 10.5% for the quarter and 6% for the first half. Chinese stocks have been the global underperformers in the first half of 2023. The Hang Seng Index has lost 7.3% since March the 31st, wiping $330 billion of market value from its 80 blue chip members. For the first 6 months of 2023, it's down 4.4%, and leading the losers over the quarter, sportswear maker Li Ning tumbled almost 32%, while Anta Sports slumped almost 30%. Futures markets are indicating a gain of around 120 points at the open. That's a rise of 0.6%. On the mainland, the Shanghai Composite rose 0.6% Friday to 3,202 for a quarterly loss of 2.2%, and for the year so far, it's up 3.7%. You can get more details on all the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Welcome our guest this Monday morning. We have with us Alex Wong, Director of Alex KY Wong Asset Management. Morning, Alex.
Good morning, Peter.
And also with us, John Schofield, Managing Director of Tempus Investment. Morning to you, John.
Yes, hello, good morning, Peter.
Well, as you heard there, the Nasdaq Composite recorded its best first half of the year since 1983, after investors flocked to the tech-heavy index in the hope that they're going to benefit from the growth of artificial intelligence. 32% for the first 6 months of 2023. The Nasdaq 100 done even better, surging 39% in the first half of 2023. Alex, I guess it's getting harder and harder, though, isn't it, to chase this rally when you start seeing these sort of numbers?
Oh, yeah, of course. I think the AI story actually is reflected a lot. But I think the trend is still there because the AI story actually would be out there for quite some time, I think. So, and also people probably would find it difficult to find other investments because of the, in fact, recession fears in the globe. And also I think China probably would still be bad. So I think we probably could see this kind of a corner bull market to continue in the US.
There's an interesting statistic I found that historically, apart from 1 year, which was the year of the Great Depression in 1929, when the S&P 500 has had gained more than 10% or more in the first half, it's also up for it's been up every single year as well. But surely we're not going to see the same sort of gains in the second half, are we?
I don't know, actually. I think it depends a lot on the on several counters. I think the story in the mega tech would remain intact, and it just led the market higher and higher. So I think it's difficult to see the top of this kind of mega techs. But I think this would be a polarized market, and not every stocks would participate in the new high. So I think quite likely we would continue to see this kind of a market supported by a few counters.
But is it going to be a different few counters in the second half of the year, do you think? Because we've had obviously the 7 I mentioned, the Microsofts, the Apples. Yeah. Will it be a different 7 or a different broader sector?
Actually, I like 4. I think Tesla, Microsoft, Apple, and NVIDIA probably would still be the leaders. But I think Amazon, Google, and Facebook probably may not. So I think the concentrated film would still be there. And probably these 4, I think, would continue to lead the market, because I think people are now looking at sector dominance, and the future earnings are more importantly. So these 4 actually, I think, have there's more solid stories than others. So I think probably we'll continue to see this kind of concentration.
Even Apple's added $1 trillion in the first half of the year, so gone from 2 trillion to 3 trillion, and it's a company that's profits are slowing as well.
But I think it created a new category, spatial computing, by the introduction of Vision Pro. And the market actually is not very enforced that yet. But I think the rollout probably would be better than expected. So with this kind of a new category creating, I think probably we continue to see strength, and very likely we would see it to dig deeper in this existing customers a pocket. I think so. That's why I think Apple will still be going.
John, what are your thoughts about this? Quite an extraordinary rally, isn't it, in just a small number of stocks? What do you do for the second half of the year?
Well, I think momentum is starting to pick up, and I think the next phase, whatever that is, say next quarter, I think we may see some broadening. I certainly agree that the leading theme, the leaders will remain the leaders, but we're also going to see the S&P rally broaden out to other counters that are kind of benefiting from the growing macro confidence, I think, in the US, because the monetary policy seems to be doing the job in keeping steady downward pressure on inflation without triggering a recession. I think they've been lucky in the sense that this wave of new technological innovation, which is driving future earnings growth, not only for those counters, but of course the benefits of the increased productivity will broaden out to other sectors and other companies.
I know the stock market doesn't have to follow the economy, but nevertheless, the economic backdrop is worsening, isn't it? So we've seen this rally into a worsening economic backdrop, albeit, inflation is stabilising. But if you look at some of the other economic numbers, it does suggest a slowdown.
It's slower.
But not a recession.
But no sign of a recession. And as I say, I think earnings momentum is picking up. Other signs, for example, the US, the housing market in the US is turning into quite strong. Now that my impression is that the economy, US economy, has adjusted to the new normal set of interest rates, and if you look at things like the Chicago Fed's financial conditions index, is actually showing that financial conditions are loosening, have been on a loosening trend, despite the decline in money supply M2. But that financial conditions index is made up of hundreds of dozens of components, including things like credit spreads and stock market volatility, and we've seen the S&P, the VIX has come way down now to somewhere around 12 to 14% range, which just shows that we're gaining confidence rather than.
But the yield curve has been screaming recession all year while the market has been rallied. How long does it take for these interest rate rises, which have been going on for a year now, to have an effect on the economy then? Because, as you say, some of these indicators are ticking upwards, like the housing market and so on. So what should we be looking at? A year, 2 years? What's the normal time frame for this?
I don't know. I suspect the old economic models are probably not working in quite the same way anymore. Yes, I'm looking for. I think the bond market is probably going to back up a bit. Well, the yields are going to back up. I think normalization also includes normalization of the yield curve, and that's not by cutting short-term interest rates, but by I think longer term yields will back up, mainly because of fund flows. Now that investors have a natural hedge in cash, and they can get a decent return on cash. They're probably going to eschew bonds, and so the old 60-40 model or whatever will continue to invest in equities, but the hedge will be in cash rather than bonds.
Alex, would you be tempted to lock in these yields now? Almost 5% on the 2 year, isn't it? It's risk free. It's better than the dividend.
Sorry,
yield.
I was talking about the sort of 10-year yields. I mean, at 3.8 or whatever it is too low.
Alex, would you be tempted to lock in these yields?
I think if you have some excess cash flow, of course it will be tempted. But I think the rally in the AI actually would be a very rare theme to play by. So it is also a very rare occurrence in the history. So I think you need to take some risk at this era, I think.
I'm wondering, though, where the shocks could come from in the second half. So many people are talking about this rally sort of continuing. So many people like the AI sector. I'm just wondering where the shock could come for maybe the equity markets or the credit markets in the second quarter of the year that could potentially derail all of this.
It is very difficult to call, but I think because, first of all, I think the shock, we would see some steep correction occurring, I think, because we have been in a steady rise for quite some time. So every correction, I think, would trigger some profit taking and probably would last for not very long time, probably 3-4 days correction, and the magnitude probably would be a little bit bigger than usual. Just like we are seeing those kind of rebounds in Hong Kong. So we probably will see a sharp rebound in Hong Kong and a sharp retreat in the US in the second half. But those probably may not be sustainable. I think people would still engage in the long-term story. So probably they will still be looking to pick up because I think many people miss this rally. So very likely we'll see this kind of buy on dip attitude to remain in the market. So I suspect a major shock may not be easy to come unless we are seeing some major governments putting very severe restrictions on the development of AI. I think that probably may be the shock, but that I think may not likely to happen in the West.
What about a shock in terms of if interest rates go up further, they cause some sort of market accident like we saw earlier this year in the regional banks in the US, although ultimately the markets sort of shook it all off, didn't they? But it seems to me that it's getting more and more likely that we're going to see some sort of market accident at some point as certainly the Fed and the ECB ramp up rates further.
Well, I think, first of all, the inflation is picking out gradually. So China actually is exporting some deflation. So, and also the commodity markets actually is not rising already. So we are seeing signs of hope in the inflation containment. And then, so we probably may not see a very aggressive rate hike by the central banks in the world already. And then, and also I think the Fed handled the regional crisis quite well. So probably people would have confidence that they could handle this kind of shock in the future as well.
John, do you worry about a market accident as rates go higher?
Not really. I think if we just focus on the Fed and the US situation, the Fed has been remarkably consistent over the last year or so, despite markets occasionally panicking one way or the other that they're going to have to start cutting rates. They've tightened progressively and steadily up to their forecast of just above 5%. So we're almost there. Meanwhile, but what needs to happen is for a sustained period of short-term interest rates being above the rate of inflation, which is where we are now in more or less in the US. I wouldn't be surprised to see one more touch up in the July Fed meeting. But then as long as inflation is stable or slowly declining, and there's a real interest rate of say around 1%, then I think we'll have it's quite stable monetary conditions. So I don't see that. I don't really see that the shock coming from the US. European situation is slightly different. Because the economy there is much less robust. Again, partly because they don't have these mega tech companies to rely on to produce the growth that we're seeing at the moment. Japan also, I think, there's potential. The Japanese situation is not sustainable. 0 or even negative interest rates still. The yen is sort of weakened near to the top of its long-term range.
Could that be where the market accident occurs in Japan?
Well, yes, don't forget there's a huge, debt bubble in Japanese government bonds, 270% of GDP or whatever it is. People have chosen to ignore that because the stock market is doing very well for a couple of reasons. One is the changed, corporate governance environment in Japan, plus the fact that they have a good share of the leading global technology and high-end manufacturing companies in the stock exchange. So that's one side of the equation. But sooner or later, they're going to have to give an interest rate to people to stabilise the currency. And
it'll be interesting to see how the Bank of Japan gets out of this ultra-loose monetary policy without sort of upending the markets in the process. Yeah. What about China markets, Alex? The Hang Seng down more than 4% in the first half of the year. It's out of the 92 sort of primary indices that Bloomberg track. It's almost the worst. There's only a couple worse than the Hang Seng. But what about the second half of the year?
I think it would still underperform. First of all, I think people don't like the AI stories in China because of the risk of government regulations and also the constraints on chips imposed by the Western world. So I think the AI film is not playing out in China, or it just pay out in some mid to caps and not the large cap. So it will not have a help to support the market. And then we have the renminbi to continue to depreciate. And the government seems to allow that, and I think this is hurting the value of the cash flows of those stable SMEs. So those stable SOE, sorry. So we are seeing some kind of pressure on those leaders like China Mobile, China Telecoms in the recent months because of the weak renminbi. So I think the problem in China probably would persist because we have just get a bubble burst on the property market there, and also the lack of technology film, and then also the renminbi is weakening. So I think this is not a good environment, and also people chose to buy on European or Japanese companies for the consumer names in China, because those companies also have active participations in the local market, in the China market, but they probably will be safer to bet. So that's why we are seeing a devaluation of Li-Ning and Anta very severely recently. So this kind of choice, I think, will still be made by those foreign investors. So very likely we would see continued weakness in China, because if you want to play the India film, you also can get into those multinational companies, I mean the consumer names. So that's why we are seeing weakness in almost all areas in the China market right now.
John, what are your thoughts?
Yes, pretty much the same. The macro background's pretty awful, and then you've got the very specific problem of China not being able to tap into this theme of the new wave of technological innovation for various reasons, including the geopolitical one. So until we see some change in the regulatory environment, in particular, which is basically very hostile, I think, to foreign companies operating in China, and I think very few will be tempted to increase their investments in China, manufacturing in China.
But they say, I mean, if you listen to Xi Jinping when he met with Chris Hipkins, the New Zealand Prime Minister, last week, we're open, we're going to look after foreign investors. Is it just talk?
And frankly, yes, it's only in very selected areas, which kind of narrows the options.
Are foreign investors taking a big risk here? They're very underweight now, aren't they? The China market, they were net sellers in the last quarter from April to June, sold about 2.7 billion yuan of mainland shares. That's the first quarterly outflow we've seen since the third quarter of last year. But they're at risk, aren't they, here? If we see a sharp rebound now, they're really going to underperform.
I think that still kind of sharp rebound may happen from time to time. But if you look at a longer term horizon, say if you look back in the past decade, actually if you not invest in China, actually you will not lose much, because over the decade we have been underperforming so much. so I think people are taking a longer term horizon, and they are fed up. So and also the story actually is not changing. We need to see a very drastic change in the Chinese government attitude towards the private sector. I think that's the key thing to change. Another thing is the constraint imposed by the U.S. on the semiconductors industry. So that is the two key things in investing in China. And if we are not seeing drastic changes in either one of them, then probably we may not see sustainable reversal in the Chinese market. So from time to time we may see short squeeze, like 2,000 points rally in the Hang Seng Index, just like what happened in early June. But that will not be sustainable, because I think the key in fundamental would be the government regulation risk, and also the lack of technology advance because of this chip industry. So I think these two are the really key variables, and without key changes, I think we will not see a reversal. And people are probably may underperform for a while, but they will not underperform in a 2-3 years time horizon, I think.
So to be clear, what you're saying here is really to see a sustainable rally in China, because there's a lot of optimism at the moment out there about the second half, but you're saying to see a sustainable rally in China, one of two things have got to happen, or ideally both: a change in the political environment towards foreign investors and foreign companies.
Or private companies, I think.
Private companies, and then also an improvement in the geopolitical situation.
That's the two key changes needed. Either one would help. But what you say about the optimism actually is a limited optimism. We're talking about the targets of the Hang Seng Index is only around 22,000, 23,000, which is fairly limited actually, because we have already seen that in early January this year. So I think people actually are lowering their targets, and they are getting fed up. So I think really they are not that optimistic. So even though they are talking about a 15 to 20% upside, actually this is just a catch up, not a really reversal.
John, let me get the final thoughts then from you. Do you agree, first of all, with those two key things for a market rally to be sustainable, and change in attitude by the Chinese government towards private companies, and then also an improvement in the geopolitical situation? Are they, in your mind, the two key things to get this market really going on a sustainable basis on the mainland?
Yeah, I think that with those two, but then we still have to think about the macro environment, the debt problem, the property sector, and that kind of thing. So
it's even worse.
Yes, I mean,
several
whichever
things.
way you look at the moment, we're in a bind, or people investing in China are in a bind. Yeah.
And if you look at the economic data that came out, the factory activity shrinking for the third straight month, and the services side, the non-manufacturing, although it's still expanding, it's slowing down. It doesn't look like the macro picture is getting any better, does it, if you look at these PMI data?
No. People are talking about monetary stimulus, and I don't think that will have any effect when we've got all this debt out there, which people really want to reduce. So I think any fiscal stimulus, again, it should not be targeted to the same old infrastructure and fixed asset investment. It needs to be targeted towards services and maybe healthcare, welfare, things like that to get the confidence of the Chinese consumers back. I mean, at the moment they're drawing their horns in, trying to repay their mortgages and increase their savings and not spending money.
The China Beige Book, its latest quarterly report, it said basically this stimulus just isn't working.
Yes, I saw that in your report. That's right. What's it pushing on a piece of string or something like that? Yeah.
Yep.
No, that certainly seems to be the case.
Okay, well, thank you both for your thoughts there. Very interesting discussion this morning, and lots of good ideas there about what to look out for going forward. You heard there John Schofield, who is Managing Director at Tempus Investments, Alex Wong, who is Director of Alex K.Y. Wong Asset Management.
Peter Lewis's Money Talk.
I'm joined now by Geoff Howie, who is market strategist at the Singapore Exchange. Morning, Geoff.
Good morning, Peter.
Just before we start talking about the markets in the first half of this year in your region, I just wanted to get a quick thought from you about your new tie-up that you've been working on with the NSE in India, and there's going to be, I think, a new contract, isn't there, on the NSE Nifty 50 called the Gift Nifty from now on.
Yeah, that's exactly right. It's Gift Connect is now fully operational, so that's involved the transition of our SGX Nifty derivatives to the NSE International Exchange. So all those US dollar denominated Nifty derivative contracts, they're now exclusively traded on the NSE International Exchange through this Gift Connect, and it defragments the Nifty market, and the initiative is obviously looking to grow international as well as domestic liquidity pools, so that should, in theory, bolster activity in the India market. So we've migrated all our open positions in SGX Nifty. We did that after the Friday closed, and thus there's no open interest remaining in SGX Nifty, and those SGX Nifty positions were all converted to the NSE International Exchange Gift Nifty positions based on a conversion ratio of 1-to-1.
If you're an international investor or you're based down in Singapore, can they still trade through the SGX, albeit the positions will end up on the NSE in Gujarat, but can they still access the market through the Singapore Exchange if they wanted to?
Yeah, well, the thing is, with this arrangement, we Singapore and India want mutual growth and liquidity. That's our focus. And we've got this SGX India Connect IFSC as a special purpose vehicle. So, and this we have this wholly owned subsidiary incorporated in India. So we route through our members' orders on Nifty contracts to the Gift Connect for trade matching. And that means that trades executed through SGX on the NSE International Exchange, they are cleared on the NSE Exchange, IFSC Clearing Corporation, while at the same time simultaneously cleared on SGXDC as a central counterparty for our clearing members. So your members, our members, SGXDC members and your investors will be subject to SGXDC clearing infrastructure and risk management. So there's no open interest remaining here, but when it comes to the execution and the clearing, we're certainly involved.
Okay, well that sounds great, and presumably there's good opportunities for new products going forward in the future.
Yeah, especially on the different sectors, as you've seen, obviously in Hong Kong and Hang Seng, and the various need for investors to have the big benchmark indices fragmented by the various different sectors such as banks, financials, and tech.
Okay, well, let me ask you about the performance of the Southeast Asian region in the first half of the year. It's been a bit disappointing, hasn't it? If we look at the top six sort of markets there, in Singapore, the Straits Times is down 1.4% year to date. The Jakarta Stock Exchange Index minus 2.8%. Poor old Thailand, almost 10% down. Philippines, 1.5%. Malaysia, almost 8% down. But the big standout, Vietnam, up over 11%. In the first half, slightly bucking the trend, isn't it, of what we've seen elsewhere around the world?
Yeah, that's exactly right. But Vietnam is a peripheral too when you consider that Vietnam, the central bank is actually cutting interest rates now on an accommodative stance. And the reason being is Vietnam's GDP growth of, 3.3%. That's about half the forecasts that we were expecting for Vietnam, that the world was expecting for Vietnam this year. And for that reason, you've had Vietnam up around 11% in the year to date versus that 2% decline we've seen for our broad regional benchmark, the FTSE ASEAN 60 index. So, as you mentioned, STI has been pretty flat when you consider the dividend returns as well, and that follows us being the best performer last year. And the story is, it's a familiar story for investors across the world: decelerating global growth, the new switch to a China services-driven recovery rather than the traditional investment-led recovery. This is having a pretty big impact, as well as interest rates staying high longer in the West. we saw, actually it was exactly a week ago, there was a paper by, it was their annual paper by the Bank of International Settlements, and they noted that positive growth spillovers in Asia from a China services-driven recovery should be limited with no actual significant impact. The reasoning is services are a lot less tradable and more orientated towards domestic demand, and they actually showed that in the previous not regimes, but in the previous, I guess, growth cycles in China between 2004 and 2019, if you had 1% year-on-year quarterly growth in China construction activity, that increased Asian manufacturing exports to China by 0.7% over the next four quarters. And then if you had the 1% year-on-year growth in China manufacturing output, that increased Asia exports to China by 0.6%. Whereas if you've got the services growth, there's a negligible impact. So that's a big one. But at the end of the day, you do have a lot of diversity here in Southeast Asia to contend with the decline in this decelerating growth and the impact it's having on exports. You've got Thailand. Actually, on the other hand, it does have a very low policy rate. I think it's the lowest in the region. So you've got that at 2%. And then you've got in the Central Bank of the Philippines, they maintain the highest policy rates at 6.25%. And for Singapore, look, our economy grew 0.4% on the year in the first quarter of this year. Next week we'll get the preliminary figures for the second quarter. It has been slowing, and if you look at our best performers in the market, it was auto manufacturers. In fact, it was auto manufacturers were the best performers in June across the world and across the region. And in Singapore, we had Neo and Jardine Cycle and Carriage, and also that green theme has also seen Sembcorp Industries and Yangzijiang Shipbuilding outpace. But for the big themes for the region, I think it continues to be digitalisation, the growth of semiconductor fabrication here, fortified, diverse supply chains is also important, and obviously the upstream green mining are making up those key economic themes of the region for the second half.
If we look forward for the second half, I'm wondering, these markets, although it's a diverse region, as you say, and you can't treat all these markets as the same, but I'm wondering if these markets could be the hidden gems of the second half, because on the positive side, I know obviously they've been affected by global slowing growth, but on the positive side, as you mentioned, the economies are doing quite well. The central banks seem to have got inflation under control in these markets. Some of them are benefiting from the rerouting of trade, supply chains away from China. So obviously countries like Vietnam definitely benefiting from that. And they're sort of immune, aren't they, from also the geopolitical tensions that you have between the US and China. I'm just wondering, maybe, these markets have been overlooked, focusing too much on the negative, but there's quite a lot of positives for them that maybe people should look at in the second half of the year.
Yeah, that's exactly right. I mean, we're not the hugest stock market in Asia Pacific, obviously, but there is a lot of economics, a lot of exciting economics behind it. And for quite some time now, pretty much the last 20 years or so, we have been on these reform tracks to increase connectivity between the 10 ASEAN states. And with a lot of demand in a lot of I guess the upstream green mining, the renewable raw materials they use to power batteries, much of that is found here in Southeast Asia as well, and this is creating a lot of FDI opportunities, and that brings money to the door. And then when there's international money wanting to go to work in ASEAN, it means that some of those barriers that we've had in the past, like higher transportation costs or different levels of customs to get business done, a lot of that integration really gets spurred on, and we can overcome those obstacles. So having these fortified, diverse supply chains where you don't have to just concentrate on one link in the supply chain but can diversify it out is very important, and that's what we are aiming to achieve here. And of course, having the pretty strong consumer demand here as well across Southeast Asia, it also works with digitalisation. So, yeah, there is a lot of good timing, certainly when it comes to the global economic front here, Peter.
Let me ask you finally about one of my favourite markets, which is down in your region, which is Indonesia. I'm sort of, quite excited by the prospects for Indonesia because the fundamentals look good. There's reforms going on. The economy's good. It's got a current account surplus at the moment, and you have all these IPOs coming as well as the government sells its stakes in nationalised industries. Tell me your thoughts about Indonesia.
Oh, very strong. I mean, from the outset this year, it has been quite strong, and we saw that built into market expectations in the Jakarta Composite Index as early as last year. And the key thing is inflation expectations, as the Bank Indonesia says, are very well anchored, and it expects headline inflation to return to the target range of 2 to 4% this quarter, which is very different, obviously, to the West when you've got Fed governors that come in next year as voting members saying that rates could be on, at these high levels up to the end of 2020. Bank lending is also growing steadily to double digits in May, or almost double digits in May. I think it was 9.4% year on year. And at the same time, that Bank Indonesia is strengthening its macro-prudential stimulus. So you've got all four working well for them in terms of the policies, the prudential, the monetary, the fiscal, and of course structural as well.
Okay, well, great. Thank you very much for that. A nice update on the Southeast Asian region. That's Geoff Howie, who is the market strategist at the Singapore Exchange. You've been listening to Money Talk. If you want more information on any of the stories we've discussed today, please take a look at my daily newsletter, which you'll find at peterlewismoneytalk.substack.com. Tomorrow on the show, I'll be joined by Asian fund management industry consultant Stuart Aldcroft, Richard Harris, who's Chief Executive Officer at Port Shelter Investment Management, and our US economics correspondent, writer and broadcaster Barry Wood. See you tomorrow.
Money Talk